Hi everybody! I recently read the book The Education of a Value Investor by Guy Spier. Guy is a highly successful hedge fund manager and I recommend his book. Let me state in advance, I'm not a value investor myself at all, far from that. Nevertheless, when I browsed through the book, I could immediately recognize that there are some very important points for any of you, whether value investor or not, for any kind of investor as a matter of fact. So I've picked up the top 5 points that I could pick for you to help you profit significantly in the markets. How? By adopting healthy trading habits. Let's start. One of the most important elements of value investors, like Guy, is patience. Guy says that being patient is almost always the best choice for investors, and that's one of the reasons he doesn't check daily his portfolio. He also stresses that our brain is the weakest link, and since we cannot make rational decisions, as been proven by science, it's imperative to find some kind of a bias. We have embedded mental weaknesses, and our brain is so easy to fall prey to illusions in the market. To me, regardless of the time frame you are trading, whether your window of opportunity is 1 week, 1 month, 1 year or more, you must avoid at all costs the following 3 fatal elements. Number 1, intradaily stock data feed. Even daily feed is unnecessary most of the time. The cure is automation of your orders. Number 2, news feed. The killing element for whatever opinion you have, news will cause you to doubt yourself and your position. And get this, 97% of news is trash talk and you just cannot tell the true from the trash. So forget about even trying, just avoid it altogether. And number 3, experts and gurus in their own eyes, this type will feed your head with bold predictions that have very little with the actual future action. Real and rare mentors like Ray Dalio don't spam you with predictions, but instead they give you principles. And principles are the best gift that you can wish for. So don't get fed by the feed. Guy likes to quote Warren Buffett, and for good reasons. He learned a lot from Buffett, as you and I should too. All good investors are good learners. During their meeting, Buffett told Guy, "People will try to dissuade you from doing the right thing if it's uncommon or unacceptable." Well, that to me is gold. But hey, most people would rather die than do the uncommon thing. What is, in your opinion, the most common thing in investing which will cause the greatest damage of all? That thing is riding bear market with a long-term investment. People tend to justify themselves by saying, yeah, but a bear market only happens once every several years. That is true, my friends, but 1 year of a bear market could destroy profits of 5 years accumulating during a bull market. So what's the point in that? That is counterproductive to the entire notion of compounding wealth over the years. The most precious asset that you will ever have, time to build your fortune, is wasted and is never to be recuperated. Never, ever. And I'm not even addressing the huge mental pain. Guy himself, in the most honest fashion, goes in depth into the pain he suffered during the crash of 2008. He says, "I have from that period all sorts of memories I've repressed because dealing with them is almost an unbearable burden." Guy is not only a brilliant investor, but also rare in the arrogant landscape of Wall Street. I would refer you to another great quote from Buffett. Don't solve difficult problems, avoid them. And bear markets are the most difficult problem an investor will ever hit. He'd better avoid them. Or better still, make money going short during the downhill phase. Guy advocates for taking control over your awareness. Imagine your desired future as a means to success. The point is, you must envision the future you want before it actually happens. I guess that has become obvious by now, but also surprisingly overlooked by most people. Everybody already heard it somewhere, but most don't really use it. When talking to beginners in trading, I realized that they find it hard to see themselves as the image of the trader, quote unquote. You know, the type that is a day trader sitting all day in front of the screen. So they quit and never go any further. People cannot see themselves commit to growing 5x their money, which is absolutely possible, just because of a scary, unrealistic image. And that's a pity. I suggest the starting point should be something simple, light, and easy. See yourself committing only 10 minutes weekly during the weekend when the market is closed. If growing 5x your money in a few years is a goal for you, do as I recommend, and in time, as Guy explains, your vision will become your reality. You will reach your big goal with one small step at a time. Why would I want a checklist? You probably wonder. Am I a beginner? A softie? Guy is neither a beginner nor a softie, and he does a checklist. As a matter of fact, he worked his butt to come up with a highly detailed checklist to protect him. From what? From whom? From himself, of course. I need a checklist, and you need it too, because we're not as smart as we think we are, and not as strong as we think, and not as immune to behavioral biases that we all share. We need a checklist to protect ourselves from repeating past mistakes. Remember that avoiding predictable mistakes is equivalent to making money. And in the long-term calculation of compounding returns, it means huge fortunes. Repeating mistakes is for your capital like dancing Scooby-Doo. One step forward, 2 steps backwards. So forget about skipping the checklist, or you are going to end up skipping your entire capital growth. Guy also went to some length and depth to explain when and how he started to notice that CEOs of corporate America are actually great salesmen of the image of their companies, rather than reflectors of the business reality that investors are thirsty for. They pull you with their charisma and charm into the black hole, which is their poor decision making. Investors will just get a somewhat rosy version of the truth at best. Guy realized that close connections with corporate executives could be destructive for his investments. He made up his mind to watch their actions instead of listening to their pitches, because actions do speak louder than words. I would go even further. In 2007, just months before the big crash, corporate buybacks went through the roof to an all-time record. Who made those terrible decisions to invest at the worst possible timing at the highest prices? That's right, corporate executives, CEOs. They created black holes in their balance sheets. And who, at the very same time, made huge sales of their own stocks? Right again, the big shareholders of these very same corporations. So my advice goes hand in hand with Guy's. Not only should you never pay attention to CEOs, words, or actions, you should focus on the massive actions of insiders, what they are actually doing with their own money, buying or selling. And these are the true fundamentals of the market that are worthwhile watching. I hope you enjoyed the video. You see, Guy Spier's investment style is very different than mine, but we share many important principles and habits. These principles and habits changed my life from a gambler in the market to a strategic, consistent winner. You can benefit a great deal by embracing them too.